Good morning. This is Jim Riggio. Today is the 2nd of January, 2017. Happy New Year to everybody. Before we get started, quick disclaimer, capital discussion, not broker dealer, investment advisor. This is presentation for educational purposes only. We have no way of knowing what level of risk is appropriate for you. Trading options is extremely risky. You should know all of your risks before you place any trades. Anything we talk about here in terms of computer simulated trades is believed to be accurate. However, due to such factors as liquidity, commissions, and slippage, your gas mileage will vary. With that, what I wanted to end up talking about, and we can end up opening this up to anybody at this point, but if there was no, and let me just take a quick look at the chat to see if you guys had anything. Okay, here we go. A couple of slides. Okay, can I talk a little bit about how I choose my Kevlar setups? Yeah, a little bit. What I can end up doing is going over the stuff that I've gone over before, asking a few questions, answering a few questions about it. But because it's the paid service, there's only so much that I can end up talking about. But I can definitely end up showing you at least a difference about how to end up choosing a structure that works in an environment. And the other one is seasonality. Okay, what types of trades? Okay, I've been looking over the last few years. Okay, good. That's one of the ones that I definitely wanted to talk about. Daniel, thanks a lot. Gail, I know that you're a subscriber, but we have non-subscribers to the Kevlar service here, so I can end up going over so much. Let me take a trade out and bring it over to the screen so you can end up seeing. What I want to end up bringing is the following. Let me just take a separate detach. I can also get rid of this. Let me get rid of all of the trades here. Let me bring this over here. So what I'm doing, I just have to get rid of all simulated trades. And let's take a look at, we can take a look at SPY. How about that? For the Kevlar stuff, you guys know it's going to be pretty similar in the SPX. Here's the way I take a look at, for those that you don't know about the question, okay, in the Kevlar, I end up having two separate setups. Okay, one I'll end up using when the implied volatility ends up dictating. And when I say the implied and how it dictates it, it'll determine whether I go into what I call mode 1 or mode 2. I was, reason why I was a couple minutes late, I lost track of time. I was just speaking to John Locke. And as we were talking, we were just talking about how, we go into different structures. And we both end up talking about having to trade the environment that you end up having, not the one that you'd like to be able to end up seeing. And the way we end up taking a look at that is in different ways. Now, I look at it this way because I've done this for a long time, and this is just my method. I'll end up showing you the way some other people do it, the way, like, for example, I talked to John about the method that I learned this in. He talked about the method that he learned it in. Both of them are extremely valid. They're just different experiences. The way I would take a look at things is I would take a look at how much the implied volatility goes up as the price goes down. So you could do this pretty much in any of the equity indexes, okay? Now, also you can end up taking a look if as the price goes further up on the call side, you can also see how the volatility goes down, hits a low point, okay, and then starts to go back up. Now, here's where it hits the low point. It hits the low point when it doesn't make any difference anymore, because if you take a look at how much the prices on these calls, they get to be extremely cheap. And then what ends up happening is that the difference of whether, say, this is, 3 cents versus 4 cents on the bid ask, or if it's 6 cents versus, right, that's a big, big difference from a relative point of view. You say, oh, Jim, it's only a penny or 2 pennies. Yeah, it's only 2 pennies, but look at that. Going from 3 to 5, that's huge, right? That's a 2/3 increase in the price of this. So yes, the implied volatility goes out. This area where the implied volatility is the lowest especially when you only have, in this case, 18 days left to go. I like the term that Paul Demers uses. He uses the belly of the curve, because if we were to map out the implied volatility, and let's do that. You can see that in Thinkorswim, and let me show that to you. If you come over to here to product depth, and let's just view it this way. Instead of viewing all, let's view just the out of the monies. Okay, and let's go out, say, 14 straight. Now you need more than that. The problem is I got to get rid of some of these lines. Oof. Let's take them off and just let's look at the monthlies. Maybe this will be a little bit easier to see. Okay, we'll go out to September. That's good enough. And instead of 14, let's see what 25 looks like. Still not enough. 50. Okay. A couple of things. First one, this bump, okay, it's really not there, okay, and here's why. The calculations, right, the calculations that are used for this, well, let's go through what we're actually looking at. I think that might be a better thing to take a look at. What we're looking at is the implied volatility at each strike price, and you can see the strike price here along the bottom. Right? Let's make this a little bit bigger. That's as big as it's going to get, huh? We're looking at the implied volatility along the bottom. Now, the challenge, okay, with that is they, Thinkorswim and almost everybody, does not do what are known as discrete dividend calculations. What's a discrete dividend? When you take a look at the implied volatility, if you were to go through the Black-Scholes and binomial formula, you end up, one of the things that you put in is the dividend yield. Now, when you do that in simple math, you put in a dividend yield for the year, and the way the calculations would end up working is it's as if you would get a tiny piece of your dividend every single day, instead of the once of a quarter, the way they would normally work. So what ends up happening is that the puts end up using the dividend differently than the calls do. Obviously, one comes in, one goes out. But that's a big difference in the calculation difference between what you end up buying and what you end up selling. So instead of using the out of the money, if I was to end up using, let's say, just the puts, you can see what ends up happening here, how the implied volatility ends up, okay, being, just totally, kind of screwed up. And if I was use the calls, okay, it's a little bit more accurate and I don't have as much of a bump. Okay, so calls may end up looking a little bit more accurate, but what's going to happen is that if I take a look at the implied volatilities, they're going to end up being different than what the calls are. So if we take a look at, let's say, this area right here at 2010, you can see where they're all here, and we're all clumped up near 20%. If I go back to the puts, and I go back to 210, look at where they're all clumped up. Okay, 17 and a half, let's say. Right, so the implied volatilities will look very, very different. But what I'm looking at, okay, in terms of any structure, okay, think about what we're trying to end up doing. Okay, what we're trying to end up doing is that we're trying to end up selling volatility that we think is a little bit high and buying volatility that we think is a little bit low. Right, from a historical point of view. And so one of the challenges that you end up having, there's two challenges, okay? The first one is, what does the implied volatility look like on this from a historical point of view? And people say, oh, Jim, that's easy. You just look at VIX. Yeah, it is. But what happens if you want to trade something else? Okay? So, oh, well, that's easy. If I trade the Russell, I'll just look at the RVX, right? Just so that you guys end up knowing. Let's take a quick look over here. Let me pull this thing out. I just want to get a graph to be able to end up showing you some basic stuff. Sorry, it's just taking me a second to detach it. There it is. Let me come over here. Let me just get rid of all of these drawings so that you can actually end up seeing what I'm doing. Okay, so here is the SPX, and we were looking at SPY. Right? Here's SPY, and if I were over a history of, several years going back, so, if I wanted to see what the volatility looked on that, it would be easy. It would be able to take a look at the VIX, and I can see where the VIX was on everything. But what would I do if I wanted to end up seeing what the 60-day volatility is, right? Most of you guys have strategies where you're getting in, let's say, between 60 and 90 days. What happens if the 60-day volatility is different than the 30-day volatility, right? So it's a little bit more challenging, okay? So a couple of things. What do I end up looking at? I can take a look at a snapshot in time of the puts or the calls. I can take a look at the out of the money and just, know that this is not the correct piece in here. Oh, I should have done it that way. We come back to all. Right. I can come back and I can take a look at, a specific piece. But I can't go back and I can't take a look at, let's say, the skew over history. See, that's the hard part. Oh, I'm sorry. I think I hit mute. Can you guys still hear me? Just give me a yes if you can. I'm going to keep going until I see a yes. Okay, thank you. The challenge is, how do you do this over time? There's two things that I take a look at. You can end up learning this just by trading it over a long period of time and back testing it. One of the things, that John Locke had learned, and the way he takes a look at this, he did this through experience, many, many, many years of trading. And the way he would see how high the implied volatilities were in a specific thing, now let's, instead of looking at a whole bunch of things, let's just go and take a look at, something they might be trading. Let's go to take a look at the Marches and the Febs. Just these two. So now I can see what these two implied volatility curves look like. I'm just going to keep it on calls, knowing that it's slightly different, but it's just smoother curve. And so I take a look at this, and I can end up seeing how steep this is. Now, here's what this ends up affecting, What this ends up affecting, I have a two-step process, right? I have to go and take a look and see at how high the implied volatilities are here, and how high they are here. Now, when I'm going to end up putting on a butterfly, now I don't care, John and I were talking about this, I don't care if you're an M3 trader, you're a rock trader, you're an M21, bearish butterfly, Kevlar trader, or anything else. If you are trading one strike against another, here's what's most important. If you're going to end up selling a point and then buying another point, one of the things that you want to end up being able to know is this higher or lower than historical values? And people might say, well, Jim, this is higher here, so aren't I better to end up doing this? The answer's no, not necessarily, because if I was to end up doing all of the math and showing you what historical distributions of price movement look like, and take this through time, and here's what I mean by take this through time. Well, let me go and be specific. So I'm going to put some of these things on, and then I'm going to take them off again. And then let's go on to the Januaries. If I was to take this through time, and you could see over here, and by the way, the color doesn't tell me which ones they are, but this was the oldest one, which was, what was the oldest? September, then June, then April. So it's a little bit tough to tell because they don't tell us here. But they basically go that the yellow one here is the one that has the most days to expiration. And this one here, this orange-reddish color, is the one that has the least amount of time to expiration of the ones. And I just chose the monthlies, so January, February. And so what you'll end up seeing is that each month, as time goes by, the curve becomes steeper and it becomes more skewed up at the top, meaning that we have a belly of the curve. And we know that the belly of the curve ends up happening because as you get closer here, the implied volatilities become so cheap that people are willing to pay a lot of money because it's only a couple of pennies. A lot of money in a percentage value, not an absolute value, right? So, that's why I say, I'll pay 4 cents instead of 3 cents. It's only a penny. Or in the long run, instead of paying $5, I'll pay $5.10. So it's not a lot of extra money to end up paying for some serious movement. What ends up happening is that over time, okay, we go from the yellow line down to the red. Okay, so when I'm taking a look at the Kevlar and the way I trade it, basically what I'm going to care about is the steepness of what I'm trading. Okay, and here's the steepness of what I'm trading. So I want to go back and I want to take a look at historically how steep is this line in a historical point of view. Now, there's two things, right? There's an absolute value, how high is implied volatility, and that's what we look at VIX, right? But what I'm also looking at is how steep the line is. Now, let me show you something very, very specific, okay? And let's go out and take a look at a 74-day option. Okay, and let's say I'm going to end up doing the following. I'm going to end up just putting on a butterfly. Okay, and I'm doing this specifically here. Let's make our butterfly, 10 points wide on each side. So I'm going to just put on a butterfly. Sorry, I lost it there for a second. Let's put the top one up at 25, 220. By the way, I do this a lot. I'm sorry. A lot of times when we talk handles as traders, we talk about the last digit or sometimes even the last 2 digits, but usually it's the last digit. So when I talk about a specific handle, a lot of times I'll leave out the 2 and I'll just say put on the 25 or put on what do we have? The 15, put on the 5. Right? And I mean the 205. Okay, so here's the butterfly. Let's take a quick look at it. Structure you guys probably all familiar with. Take a look at what this skew looks like, this curve. Now, one of the things that will change is that if I change the implied volatility, okay, so let me show you, instead of looking at this on an expiration, let's change this on a single volatility step. And so what I'm looking at here, okay, on this, right, because this pink or this pinkish color line here, I think they call it magenta actually, hasn't changed. Okay, if I take a look at where the magenta line is, let's say down 10%, okay, you could end up seeing down 10%, we're up $78. If I hold it over here, you can see that we're up $78. If I go back to the expiration graph, just to show you it's the same, I hold it over here, it's up 78. So the relative piece of the graph hasn't changed, meaning that when I take a look at $100, what happened is that the absolute value up here is much, much higher. One of the things that I can end up doing is that, can I do it here? I don't know if they'd end up letting me choose. If I end up going to, oh, here, absolute. Okay, I just made it a fixed graph here, and if I change it, I don't know if it flips back. Let me see if it does. Okay, it doesn't. So you see, what ended up happening is that the pink line hasn't changed at all. If I go from here to here, if you keep your eye on the pink line, it still stays the same, slightly above 100. If I come back over to the fall step, still slightly above 100. So the only thing I've changed here is that I'm looking at 2 different volatilities. Okay? So I'm looking at 2 different volatilities. As implied volatility increases, this T+0 line will be less than what it actually says it is. Okay, very important. Less than it actually says. So if I'm sitting here looking at this specific graph with this butterfly, realize what I'm doing, okay? I have on this trade, which is negative delta. I can see it's negative delta right here. I can also tell it's negative delta because the t plus 0 line slopes from upper left to lower right. And remember back, if you remember your geometry, your algebra, your pre-calculus stuff, remember the old formula, y equal mx plus b. M was the slope. Okay, if you ever had to graph things out, m was the slope. That's basically what delta is. It's the slope of the line. Okay, so when I'm taking a look at this, I'm sloping from upper left to lower right, so I have a negative slope. If I ever slope from lower left to upper right, I have a positive slope. 45-degree angles are 1. Okay. Now, granted, we end up having, multiple trades here. That's if, just in a mathematical formula. Anyway, so I come through here and I see where we are. Now, realize this is what I'm trading. Now, a couple of things you need to know. As volatility or time passes, right, and I can do this with the following. If I end up showing, let's say, a couple of steps, what does this look like, let's say, over the next 3 weeks? Okay. You know what, instead of 3, let me make each, remember, this is what I've done. I have 3 steps here. So I have today's date, in 1 week, 2 week, 3 weeks. But this is a long way away, right? This is over 75 days. So let's make believe that each one of these is 3 weeks long, and I can see what happens in 3 weeks, 6 weeks, and 9 weeks. You can see what happens is that each day, the t plus 0 line gets a little bit closer to the expiration graph. Okay, let me go back to the expiration graph. And so you can see over here what ends up happening is that each day this line, today's line, will get a little bit closer to the expiration graph. Over here, did you see how we went down? Keep an eye on this when we go back to the 3 days, or the 3 weeks by 3 weeks. You see how, here's the dates, look at the dates. See how we go from the magenta to the blue to that salmon color to the white color? Each day we lose value over here. So what ends up happening, time will end up morphing our graph. And you guys have heard me say that each day the t plus 0 line gets a little bit closer, right? It morphs is the word that I use, right? Our t plus 0 line morphs into our expiration graph. Now, you need to end up understanding that volatility is the inverse of time. I'm going to say that again. Volatility is the inverse of time. So if I was to take this particular graph and instead of doing, remember, here's the volatility, 14, where we currently are, and then we have 19. What happens if instead of a plus 5, I put a minus 5? I'm going to do that again. I want you to watch it. Okay? Here's a volatility of 19. Here's a volatility of 14. And if I make this a minus 5, here's a volatility of 9. A negative volatility is pretty much the same thing as time passing. Okay? I can end up proving this to you. What happens if I just took volatility all the way down to 0, or made it a minus number? Look at that. Okay. Now, you can't really have a minus 35, but I just put it there because I knew that the graph would end up looking, perfectly. At 0, there's still some noise in the graph. But at minus 35, today's, or at 0, there is no extrinsic value. Okay. For those of you that don't know what extrinsic is, I'll go there in a second. But basically, here's what I want you to end up realizing. With an implied volatility of 0, your t plus 0 line is your expiration line. Okay? Your t plus 0 line is your expiration line if you take implied volatility all the way down to 0. Okay? Very important. Here's what I mean by extrinsic. The value of what we're trading Okay, over here you can take a look at, here's the theoretical price and the mark price. Okay, they're going to be similar, except for right now what's happened is the market's been closed for a few days. So the theoretical price is going to end up looking a little bit different than what the mark price is. Once the market's opened, they use them the same unless you end up changing time or volatility. I'll get there in a second, but let's go through extrinsic right now. Here's what I want you to end up seeing. Each strike has a market price. That market price is made up of the intrinsic and the extrinsic value. The intrinsic value is the amount of money that the strike is in the money. So if we go, let's see right now, the price is at 223.53. You see that right there? So if I go up to say the 225, that's out of the money. So there is no intrinsic value. So right, because it's out of the money. It's instead of saying extrinsic and intrinsic, some people call it in the moneyness. I know, right? Make up words. In the moneyness means how much your strike is in the money. So if we go the immediate strike below, the 53, the one that's 53 cents in, and granted, they end up having, it's because the market's closed. You see that here they have that the last price, I guess, was 44. On the ask, they're doing this. If you see this, 23.44. Okay, I guess that's what it was. That's the current bid and asks. So here's the ask support. So what happens is that you're 44 cents into the money. So therefore, your intrinsic value is 44 cents. Here's the current price, right? 579. And so the extrinsic value is just going to end up being the difference between the two. Okay, so basically, extrinsic value is also called time value. Okay, it's an important thing, right? It's time value. So when I take a look at this, and I know there's going to be some people saying, Jim, it's not time value. You also have to end up considering the fact that there's an interest rate and there's a dividend and the difference. I know, but it's small. Let me just, give me a little bit of latitude here, and let's just call it time value. I know that there are those other differences that make up that, but they're small compared to the implied volatility. So I can take a look. Each one of these, since each one of these is $1, each one of the in the moneyness or the intrinsic value is going to be $1 more. You can also see what ends up happening is that the extrinsic value, okay, decreases as you go away from money. It's always going to be the most at the money. Now, here's something that's theoretically true. Theoretically true, the extrinsic value of the puts should be the same as the extrinsic value of the calls. The difference is, by the way they calculate that dividend versus the risk-free rate, and that's why they're not going to be the same. Now, what's the actual math of if they did the discrete dividend, the dividend gets paid on this date, here's when you'd end up receiving it, so this is the way we'll end up calculating the interest rate between now and then. It works out exactly. Okay, if there's any difference between the put and the call, and let's say the put had 2 extra cents in it when I included the risk-free rate and the dividend, the discrete dividend, we did all the math, what would end up happening? The market makers, the high-frequency guys, they would pound them until they got into sync. Now what's happened, and I was explaining this to John Locke when I was talking to him earlier this morning, is that the market makers that used to do this by hand or would take very, very large orders and then try to end up separating them, keeping them the difference between, let's say they could make an extra 3 cents or 2 cents on taking a very large order down from a bank or a pension plan or an endowment fund. They can't end up doing this as much as they used to. Why? Because the thing is that they don't have the same arbitrage ability to make money if they get something. Why? Because the bid-ask spreads on these things are going to end up being so tight. Okay, and this is what's known as the put-call parity, the fact that the puts and the calls should end up having the same extrinsic value, including the dividend calculation. Okay, very, very important. Okay, why is all of this important, okay, to answer the question, okay, how do I set up my Kevlar, or how should you set up any one of your trades? Basically, what you're looking at, if you are going to sell any vertical or buy a vertical or buy a put or sell an iron condor, is that we're looking at the difference between the strikes. So in this case, the only thing that I care about is the difference between my 215 and the 205. And so when I take a look at, remember these are puts, so they're going to be out of the money down here. So my intrinsic value of puts below the money is always going to be 0. My intrinsic value of calls above the money is always going to be 0 because they're out of the money. So when I take a look at this, I'm taking a look at the fact that we're trading at, you know, $3.22 here versus $1.69 here. I can also take a look that I'm buying, right, if in this butterfly, because I'm buying the outsides, I'm buying a 19 vol, right, 19.11, and I'm selling a 15.92 vol. Say, Jim, that doesn't really make sense. You're selling something more than you're buying. Yeah, but I'm also buying up here, which I'm buying a 12 vol, a 12.5 vol. And so what I'm looking at is the way I end up trading, or the reason why so many trades look alike. Meaning, you know, if you take a look at the theory or the premise, and we had a panel, okay, and let's say, you know, we had John Locke, myself, and let's take Dan Harvey. What you're going to end up finding is that we all want to end up selling stuff in this area. Why? Because we've traded this thing long enough that we know that as time passes, and this implied volatility ends up dropping, okay, we know that this area will decay usually quicker. Okay, how do we end up knowing that? Let's go back to the chart, right? This chart over here. Let me put this over here and come over here. And let's get rid of, let's put in January. And let's also put in something that only has a couple of days left to go. No, that one's going to mess up the graph. Okay, this one doesn't mess up the graph. Okay, so if you take a look at this, what were we selling? We were selling, right, just remember, it's down here, we're selling the 15th. So when I take a look at this, what's going to happen is that I know that implied volatility is going to end up going down in this area. When I take a look at the 205, I know implied volatility is going to go up on this. And then I also know that I'm going to kind of get crushed, okay, with my 225. Right? Volatility is going to come way, way down on it. Okay, and it's going to end up being, you can end up seeing it's going to end up coming down rather significantly. So when I take a look at my pricing, how much is my extrinsic value here? Well, I'm buying one of these, right? I'm buying one of these, but I'm selling two of these. So what's happening is that I'm spending on my extrinsic value, right? I'm spending 480, let's call that. Over here, I'm receiving, okay, 321 times 2. So that's $6.45 if we round it, right? Actually, if we don't round it, it's exactly 643 if we don't round it. And so there's more money that will end up decaying here. I take a look at how quickly the money will decay. Well, over here I'm going to lose 3 cents. Here I'm going to make 4 cents. And one of the things that's going to happen, okay, way over here is that this is the implied volatility that's going to go way, way up. So if you take a look at where we are here in March, right, we're at 19. Let's take a look at where that 205 is going to end up being when we have, let's say, a week and a half left. Where's the 205? I don't even have the 205 on the graph. I need more lines. It went up to 25. Now, granted, why did it go up so high? Take a look at where its bid-ask spread is. It's down under a dime. But it's very high. So I know that value, okay, in terms of how they're going to decay, is going to be greater in that general area over here. Okay, I needed to do all of this to end up giving you a base for what we're doing. Okay, if implied volatility is high, okay, if implied volatility is high, what's going to end up happening is that the prices are going to be high. Remember, right? Every single long option is long vega. Right? If you guys don't know that, think about that again. Every long option is long vega. It's also long theta, and it's long gamma. Okay? Every one of them, right? Take a look at these puts. You see, there's a minus sign in delta. So if you buy these, you're going to be long gamma, long theta, long vega. Okay? Now, let me show you, okay, and I can end up proving this to you right now. Okay? Let's come over to here, right, because we're on our puts, okay, and we're looking at this line. One of the things that I can end up doing is that I can end up actually changing the theoretical price of these things. So, for example, if I came over to here, I think this is where I can end up changing volatility. Will this change the theoretical price? There's always two places to end up changing it. No, that didn't change it. That only changes the graph. If I take a look at over here, okay. So look what happens here. Let's take volatility up, say 10 points. Okay. And now I want you to look at what we've been doing here. Right? Here was the theoretical price. And right next to it is the mark price. Okay? Did you see what happened to that when I clicked on it? Let me go again. Let me reset it. Watch what happens when I hit reset to the theoretical price. I want you to keep your eye on the 501. See, it went down to 168. 169. So by changing the volatility and moving it up, the price goes up. Why? Because I'm long volatility. Remember what volatility says. Let's reset again. Volatility says that this price should go up by 25 cents if vol goes up by 1 point. Well, let's call them out on it. Let's see. Okay, so 25 cents added to this is what? 84. Right? Yeah, 184. So let's take this thing up 1 point and see what happens. Did I do my math wrong? Yeah, I did. It's 194, not 184. And that's exactly what ended up happening. Okay? So what vol tells me is that if the volatility of this specific strike, very important, of this specific strike goes up by 1 point, it's going to go up by 25 cents. Okay? Very, very important. This specific strike. Now, here's what ends up happening, right? All of the stuff I've talked to you about has been theory. And it all works, all the math works out. Okay? Here's what's different. What's different is that in reality, or in practice, remember, Yogi Berra's, in theory, there is no difference between practice and theory. In practice, there is. In practice, not every one of these strikes are going to go up by 1 point if the VIX goes up 1 point. Right? They're not going to move at all the same rate. When I talk about something having a steep put skew, what I'm talking about is that the implied volatility of the strikes over here are relatively higher than they are here. Well, says Jim, they are already higher. Yeah, I know they are. But what I'm talking about is throughout history. Okay. One of the things that I look at all the time is I take a look at what the implied volatility has been for, and by the way, the difference between the 74-day and the 39-day is going to be different, and that's going to be different to the, the 11-day. Okay, one of the things, and we've seen this, what happens is that as we get closer to expiration, these implied volatilities very far below the money tend to go up. These at the money tend to go down. Right? You already know that because of this. If I come all the way down here, we know at the money, okay, here's at the money, okay. At the money, what happens, okay, with the shorter periods of time, remember, here are our colors, okay. So March, April, July, January, and then also I just took the weekly, okay. So the flattest one, the one that's here, the lowest one here, is going to end up being March, right? That pinkish is going to be March, aqua is going to be February, salmon is going to end up being July, and white's going to, January, and then a week and a half is going to end up being in white, earlier January. So what happens is that we know that the implied volatility as time goes by gets crushed, especially above the money. That's where it gets crushed the most, right? And very far below the money, we know that implied volatility is going to go higher, right? It's going to go higher. One of the things, the reason why the line stopped is I think that I only end up having strikes that are above 25 cents. And so you can see what ends up happening is that I'm long this strike, and it's not going to now, it's also the cheapest one. How to end up seeing this on the chart? Here's one of the reasons why, even though I use, for all of this stuff, by the way, it's tougher to end up seeing. I think it's much, much tougher to end up seeing this. I end up using live vol, okay? And let me show you why I use live vol for this stuff. Okay, here is, let's not start with that one. We're on skews. Let's stick with skews. Okay, let's make this wider. 10% first 6 months. Actually, let's we're going to take the same strikes, right? The January. Is it the 20th or 8th? I don't think it makes that much of a difference, does it? Yeah, that's the right one. Okay, so here are the same ones. That. Right, so I have the January 11th, the 20th, the 17th, the Feb, the March. I don't know if I have the April also. Here's the same skew. The reason why I like this so much is that I can see where the lines are. I can end up holding my cursor over this, and it tells me if it's the put or the call, because I'm using the out of the monies. They know to use the out of the monies. They've taken and they've calculated the dividend correctly. I don't have that big bump in the center like I did before. I don't have to use all the calls. At a point, by the way, it's not always there. What I just did, okay, was that I ended up having this so that I went back 1 month, and I ended up having here are the days. And what I can do is that I can move this, okay, to any specific day. So if I wanted to see what we look like on a specific day, and by the way, it does end up taking the previous one, so what I have to do is I have to sit here and get rid of, the ones that I didn't want. And so now I can end up seeing what the specific day looks like. And I can see how steep the skews were. Now this is still visual, right? This is still visual. But if you guys remember going into the election, into the U.S. election, I end up seeing, you see how nice and straight the lines are until you get to the at the money? Okay, there was a bump in the skew. And I could see that visually, that it was tougher to see if I just had a number. So I will look at this visually, but what I also will end up doing is that I will also look at what the skew looks like historically at 60 days, because that's usually where I'm trading, right? I always want to know what the 60-day skew looks like. You can look at it at different times, but and the way I end up measuring it is I measure everything in standard deviations. Okay, are we at a 1 standard deviation higher, meaning that we're 1 standard deviation more flat than we had been? Okay, and I end up getting those numbers sent to me every single day. Okay, and it's important because it'll let me know basically how much higher the implied volatility is down at 205 than it is at 215, where it is at 225 or above the money. Right? Very important to end up understanding how steep that line is over time. So one of the things that I can do is that I can go back as much as, I don't know how far I can go back here. If I hit all, we'll be here forever, because you could be pulling in so many IVs. But I can go back a couple of years and I can see how steep the skew was, so I can see what ended up happening. And by looking at this, I'll know, because of the trades, I'll know how expensive a butterfly might be or how cheap a butterfly will be. Remember I told you John Locke learned something very different, the way John ended up doing this, the way Paul Demers ended up learning this, the way a lot of folks is that they've just back tested the hell out of this thing, and they'll know, oh, at this point in time, the butterflies were cheaper, they were expensive. What ended up happening is that depending on how cheap or expensive the butterflies get, has to end up doing with skew now. I look at skew because I can see this and I can translate everything. They'll end up doing this just on price. So for example, if implied volatility goes higher, and let's say we go from an at the money of 12 up to say 18, what's going to happen is that 12 to 18 is a 50% increase in the at the money volatility. Well, the ones down here are not going to end up increasing by 50% in all likelihood. Maybe they go up, 20% or 25%. So what happens is that the relative difference between the IVs below the money and the IVs at the money will end up being different. And if the relative IVs at the money go up much more than the relative IVs below the money, the steepness of this curve becomes less. So when I say that the put skew is steep, what I'm talking about is that the implied volatilities below the money are much higher than they are, at the money. Why is this important? Okay. Let me take you to an easier way to end up seeing this. I've showed you why I liked live vol, for looking at that. You know what? While I'm at live vol, let me show you one other thing that I like at live vol, but then I can end up closing it and moving it over to the side, is this. I can take a look at, what the implied volatility of 30 days are. By the way, I can do this on anything. Remember I told you, how do you end up trading this if you're not trading using the VIX for the S&P 500, if you're not using the RVX for the Russell, if you're not using the Vixen, the VXN for the NASDAQ, how do you end up finding out your volatility? Here is a historical graph over the last 2 years of the implied volatility of SPY for what the 30-day volatility is. Now, that's the VIX, right? Pretty much so. Their calculations may be a little bit different, but I mean, it's going to be the same, same relative graph. What does it look like at 60 days? Here's a 60-day graph. If I want to compare them, I can compare them, right? Maybe you trade in a little bit early. Here's the 90-day graph. Now I can see, if I hold my cursor here, how high, let's say you get in at 90 days. I can see how high implied volatility is over the last 2 years, for the VIX. Let's say if you trade something else, though, let's say, I don't know, let's say you're an Apple trader. How do you do this, on Thinkorswim or another platform, if I'm going to do some 90-day trade on Apple, Well, here, here's the 30, 60, and 90-day implied volatility for Apple. Okay? In individual stocks, this becomes a lot more important because if I take a look at, say, the 30 days, oh, look at all these spikes, okay? What ends up happening is that I can end up seeing, okay, where the earnings were. So look at these big drops, okay? The drop in volatility here, oh, wow, what ended up happening? Earnings passed. So I can see how volatility moved up going into earnings and dropped after it for the last 2 years. Right? So very, very useful, right? When I'm trading other stocks. Okay, and I can end up seeing. Let's say I wanted to buy a longer term. Oh, I don't do this, but let me show you what you can do. Okay, what I've just mapped out here is 30-day historical volatility versus 30-day implied volatility. Now, it's a bit of a problem, right? Because if I hold the cursor right here, okay, what I'm basically looking at on the blue line, right, that's the historical, is what the last 30 days are in terms of what the volatility is measured at this point at 27. When I take a look at the same point on the line of the 18 here, this is the implied volatility. Okay, so basically this was it measured on the same day, but remember, while historical volatility looks back 30 days, what you're pricing in here for implied volatility is basically the market's bet on what the volatility is going to be for the next 30 days. So, in its simplest form, and let's go back to the SPY. In its simplest form, if you are going to put on a short premium trade, or anything that's going to be positive theta, okay, what we're doing over here, let's say, take a look at the implied volatility. We're making a bet that the implied volatility will be, that we're going to be paid more for selling that implied volatility than what the historical volatility will be over the next 30 days. So let's take a look at, instead of 2 years, let's go back just 1 year so that I can take a look at, say, this part a little bit. Let's go into Brexit. This is Brexit. Okay, you take a look. For months, we were able to sell volatility at a higher price than we actually saw. Now, what happened was implied volatility. Remember, this is looking forward 30 days. So you have to go from over here in June. What's my date? From June 13th. Okay, remember it was what, the 23rd? Yeah, the 24th was the first day after Brexit. So when you take a look at, was the implied volatility higher? Now, one of the challenges you end up having is, oh my God, why did volatility fall off the face of the earth here, right? Why did the HV, that's what we're looking at in the blue line, why did the historical volatility fall off the earth here? If you take a look at it, it's not like there was any big movement over here. All of a sudden, everything got extremely small. What ended up happening here was that these days rolled off. So they became more than 30 days out. That's why it dropped. Now, if I do the same thing with 60 days, if you take a look at over here, I'll just make this a little bit easier to see. If you take a look at why did volatility, okay, drop off over here? Because this is 60 days after Brexit. And so taking a look at historical volatility when you have a few big days sometimes distorts the graph, but at least you can end up seeing, if you didn't have big events like Brexit or like the movements in and around the election, you could see what would end up happening, okay, in terms of the actual historical volatility. But here is a way that I can take a look at one of the trades. Like, so for example, this is what I wanted you to see. And I gave this to my institutional guys that I consult with before Christmas, okay? I wanted to take a look at implied volatility, okay, going out 2 years, history of 2 years, and we're taking a look at the 360-day volatility, okay, where we were going into Christmas. Look at how low implied volatility was. With the one exception of last summer, not this past summer, but the summer before, okay, implied volatility was never lower during the last 2 years. Okay, I know that this is very, very painful for some folks, but if you go back and you think about what ended up happening August 21st, August 24th, okay, in this drop, one of the reasons why people got hurt so badly was how much volatility moved. We came from the lowest volatility had been in years, having this huge drop and having long-term volatility. Look at this. This is like almost never happens. We went from, 15, 16 over here up to 21, 22. Now, that's a huge move for 360-day IV. If you take a look at what happened, okay, with the 30-day volatility, we went from 10 to 36, right? That's what hurts so badly, okay? Let me just take a quick look. We talked about, so can we see the belly of the curve on the options? We kind of ended up taking a look at that. I had mentioned, no, I don't think I mentioned to you guys. I mentioned to John Locke when I was speaking to him right before we started. Years ago, when I ended up, you know what? Let me get to the belly of the curve, and I'll go back to that. I don't want to lose my point here. Looking back 30 days, okay, we talked about how we could look forward, looking back. So based on the IV graph, should we buy longer-term puts? The answer for the longer-term puts was that two things. For somebody who's trying to protect a portfolio, okay, buying longer-term puts, okay, on the week before Christmas, okay, taking a look at it is usually the best. Now, it's harder to buy lots of them because there's not a ton of volume going on. But right now, they kind of spiked a little bit. But if you take a look at it, is it too late? Don't forget, the market ended up selling off a little bit. We have a couple of good days, and this is going to be a trade that I'll end up showing you. I didn't show you guys because it was an institutional trade, and I couldn't, okay, because I was working with, like I said, an institutional client. But we ended up buying, and here was a trade that we did. We ended up buying, okay, and this is a seasonal trade, a 2-year put, not a 1-year put, but a 2-year put, and we sold a 30-day put. Let me show you how terrible, okay, that ends up looking on a graph, and how nobody would end up, okay, wanting to put this trade on if I showed it to you on Thinkorswim, and I'm going to show you why it's such actually a good trade. Okay, let's get rid of this. I'm going to come over to here. Now, here's what he was trying to do. Okay, take a look at any trade. He wanted to have something that made him money, okay, if we had a pullback. He wasn't worried about a tremendous crash, but he was worried about a moderate pullback, and he wanted to take advantage of volatility, okay? One of the things that we're going to end up doing when we do the hedging class later this month is that we're going to talk about defining your objective. What are you trying to end up hedging at? So I'm going to show you the trade that he did, but no, I can't end up actually showing you the exact trade that he did. But I'm going to end up showing you the one that I showed him if he was going to be more neutral and he wanted to make it more of an income trade. Okay. So what I tried to do is that I tried to sell the meat of the curve. Okay, not that there's going to be a lot of money in this, but we're going to try to end up selling something in this range, right? 3-4% below the money. Okay. We'd also like to be able to sell something that had a lot more theta in it, But in this range is probably we're going to end up being 4 or 5 cents, well, let's say 5 cents and let's say 7 cents. Then what we ended up doing is we went out to 18. You could go out to 2019 if you wanted to, but we went out to 2018. And we look at this. These are only have a theta of around 2 cents. So the concept would be to end up buying, okay, something longer term and selling it shorter term. Okay, so I'm going to come in here and let's choose this. You know what, let me get rid of this one. And I'm going to buy 2 different diagonals just here so I can set it up. And we have to get rid of the volatility. We need to look at the expiration graph. And we need to make this relative again because it was floating. Okay. And so what I ended up doing is let's do one at a time. Okay. So we're selling the monthly, which is January 20. And we were buying the leaps in 18. Okay. Now, this has a trade, an effect of something that you guys probably don't end up realizing. And that is the fact that our Vegas are so different, okay, in this trade. Let me come and show you. I want to grab this one thing one more time. Not the skew. I wanted to grab the chart, the volatility chart. There it is. Okay. Here's what I want you guys to see. Oh, wrong one. That's funny. That's my chart that I look at all the time for my daily chart. This is the one that I wanted. Okay, yeah, there it is. Okay. And I just put it behind. Way to go, Jeff. Just not having a great day. Okay. I wanted you to see how much the short-term volatility spikes versus the short-term volatility. Okay. And so when I take a look at this moving up a drop, okay, some people say, well, isn't the trade better now? I'm selling something higher. No, it's not, right? I'm selling the 11.8 volatility, and I'm buying the 17. Is that better than when we were at 16 and a quarter versus 9? I'd rather buy this, meaning the 360-day, at a much lower price. And here's why. Okay, let me get this over to the other side again. Because when I look at the pricing of what we just did, and I can do this, by the way, equally as on live vol as I can here. But one of the things I'm going to take a look at is this particular volatility, right? This is the one that we were looking at. Look at the Vega that we're carrying, $1.18. 1 point in volatility change means that this price over here will move $1.18, right? That is rather large. Whereas on the 30-day, or 18 days, you know, we had 30 days when we did this, we only have 12 cents of Vega. If I go out to the 30-day, we have way too many strikes too at this point. So let me just go down to here. Let me go out to the 30-day and look at the same 215. Okay, we're at 17 cents. We're still, right, $1.18 versus 17 cents. So 1 point in volatility move, right? 1 point in volatility move on this graph 1 point of volatility moving on the 360-day would be well, it's a 2-year, but we would make $1.18. A 1 point move here, we would lose 12 to 17 cents. Short, if we were short. So what ends up happening is that from a historical point of view and a seasonal point of view, it's still a little bit late, but not terribly, to end up putting on this trade. And let me just get this over here. And the trade would be to put on this type of... Now, let me do this. Let me make them both calendars for a second. Okay? And let me make this one a calendar also. So that, let me just get this to have the right date. So we have the 17th, and actually it was supposed to be the 20th, wasn't it? No, we can leave it there. Let me come out over to here. We wanted to do 2 years. I did that backwards. It isn't easier to do this. Let me just replicate what I have. Okay. Now, one of the things that we could end up doing, and this was a structure that we kind of ended up putting on for him, is that we wanted to sell this, and you can see, right, this is minus 10%, so this is about minus 4%, so it spikes nicely here. But we also didn't want to have it sag as much if we ran up. Didn't worry about a big run-up from here, but we ended up worrying about somewhat of a run-up. So instead of selling, okay, the January 17th, and we said that this was going to be the 20th, right? So let's make both the 20th. Instead of selling the front month at 215, we ended up selling this at like 223. Okay, let me take the price off here. So now what ends up happening is that you can see that this has some really, really nice longer term properties. Here's where this trade gets away from you. This trade gets away from you if this thing melts up. Right? If we move up substantially, right, this will end up hurting. Why? Because the long-term puts in December 2018, which were extremely expensive, are going to lose value, much more so than the short term. Okay, so if we take a look at what the short-term ones, and we use 20, right? Big deal, the short-term ones, and let's use the 23 at the money. So what? It's going to lose $2.22, okay, or 20, whatever it might end up being. Whereas the longer-term ones, if you move up, let's say if you move up, I don't know, let's say 15 points, let's say we move up 20 points, okay? So 20 points would basically take this, okay, 223. Well, let's use 225 to make it easier. If we moved up 20 points, it would be as if we moved the price down to 205. See, all I'm doing is I'm going 20 points further down the graph over here. And so what happens is that we go from $23 to $16. And if you move higher, if you melt up, implied volatility might come down also, so you might lose a little bit more. So here you're going to lose about $7 if you have a melt up of, 10%. Okay? Now remember what he was trying to end up looking at. He was hedging, so if he ran up, he didn't mind losing some money. He thought that the market might end up coming down at some point, but he didn't know when. But he wasn't too afraid that the market was going to sell off a lot in January. But he wanted to be able to end up rolling it into another trade. Therefore, putting this trade on and rolling it over a number of months would end up helping to hedge a longer portfolio. Okay, we're going to put this on and we're going to roll it every single month. Okay, so what I'll do okay, is that I'm going to lock down these prices, right? I'm going to end up saving this, okay, and I will end up rolling this for you guys. This is not the exact trade. We use the SPX for him. Okay, we're going to use the SPY here. It takes a lot of margin to do this. Take a look. Okay, so I only have on 2 contracts, and it's going to cost me over $4,500 to end up putting this trade on. But a couple of things end up happening here. If we pull back, and you know what, the way we would probably trade ours, if I was going to do this as a market neutral trade for you guys, not so much a hedge, I'd scooch these up a little bit. Let me see what I can get over here. And how about if we took this one and made this one 220? Would that help any? Take a look at our Greeks. Now, let me leave that at 220. And you know what? Let's make this a calendar at 220. Let me leave that one there. Make another one. Let's move it both up to 220. Okay, so here's what ends up happening. Okay, here. I'm a little bit narrower. Okay, you can see my one standard deviation going out to 20 is out to here. I'm a little bit tighter in this, but I'm wide enough. I'll have one, let me get rid of this. I'll have one long 220. I'll have 2 long 220s in January 17th. Take a look at this. I have one long put on January 20th. I'm sorry, on December 21st, 2018. You can see I'm long the 220 over here. And I'm long it a second time. So I have 2, right? My anchor strike, and this is what I normally like to do, is I'll take an anchor strike someplace, okay, below the money. Okay. For him, we needed more room to the downside. And so what I actually did was, let me show you how I ended up choosing. I chose this over here by looking at the 215 versus the 220 and what the difference is. I realized that we're kind of long here, so I'm just going to show you a couple more things and we can pick this up next week. I will look at, instead of taking a look at singles, right? You see this is just a single strike. I don't know if you guys know you can do this or not. But instead of looking at a single strike over here, I can come over here and I can take a look at a 1 month deep and wide 4 verticals. Let's just do one for this. Okay, so I'm going to take a look at a 1 by 2 strike. And now what I'm looking at is that I'm looking at, and let's not look at so far. Let's go back and take a look at the 20th where we were over here. I'm looking at the difference between these 2 strikes. And so you can see that they are $0.50 wide. So maybe instead of $0.50, let's go to dollar wide. And the problem is you can't really do you really can't do 2 strikes. Let's try 4 strikes with that. No, 2 strikes. Okay, now I got $2 wide. I'm going to leave it this. I can see that a $2 wide spread would cost me, 64 cents, 63 cents. And I can take a look and see how much all of this ends up costing. So when I go through that, a lot of times I'm saying which are easier to do. And if I come way out here to what we were looking at, right, these are $4 wide spreads. See, the problem is that it just goes by number of strikes. So over here, the strikes are $5 apart, so 4 of them is going to be $20. If you take a look at over here, they're $4 wide. So it depends on what you're looking at. Usually I'll start here, and you can see that these are dollar strikes until I get below 200, then they go to $5 strikes. So what I'm taking a look at is every dollar, how much it ends up costing me. So I was looking at the 220 versus the 215. So I could see that each dollar is costing me 40 some odd cents and 39 cents. You know, is it worth it to end up spending less money, okay, to end up going back? Because we needed to have more protection. We wanted to end up being able to buy more of it. It did for him. If I was doing this as a vertical, or if I was doing this just to end up taking a look at a trade, this is the trade that I'd end up putting on, realizing I like this, knowing I have a long portfolio, okay, with my long. So would I put something like this on, let's say, if I had, an IRA where I had, let's say, S&P 500 or other index type of base stuff in my IRA? Yeah, not bad, because if it goes up, I'm going to lose money on my puts, but I know the rest of my IRA is going to go up. What happens if we go down? What happens if we go down, I know that the implied volatility is going to go up. Now, I know that, right? I know that I can't end up coming over here and doing vol steps. I can't say that the back month is going to go up 3 points and the front month is going to go up 3 points. I know that that's totally bogus. Okay? But what I could say is that, I don't know, maybe the back month goes up 1 point and the front month went up 4. How do I do that? Okay, on Thinkorswim, I can come over here and I can do vol adjustments. Okay, I can do vol adjustments here. And I can say 2. Now this takes everything up. Okay, this takes everything up. I used to be able to have a drop-down box here and change them individually. I think because I won't do this now, but I'll show you next time. What ends up happening is I can take 1 month and I can change 1 month versus another month. Okay, and so I can change them separately. The thing that I like more so on the live vol side, just to end up showing you real quickly, what ends up being done here. Over here, what I can end up doing is that I can actually come in and put in my own theoretical volumes. If I take a look at my track volume, I can actually end up setting volume or setting my IVs individually. Okay, and I can come in and I can put in my individual bottles. That ends up making a really big difference, okay, where I can come in. So right now, okay, everything was just set at 2. If I end up hitting track vol, right, I can set different, and I can end up leaving vols so that they're set to be they're set to end up being what the implied volatility would end up being. Let me clear everything out. Nothing's in here. So if I wanted to end up coming in and just changing, and I'll just show you one real quick. I could say, don't price this at 12, price this one at 14, and then I could go down and I can trace something else, and I can say, price this at, 25. And so I can end up actually importing my own implied vols, and I can see everything, so I'll just clear them out. So with I can end up doing a lot more custom stuff that I like a lot more in terms of putting that into LiveVol versus put it into Thinkorswim. But here is basically, the trade. We were a little bit wider. We were a little bit more on the downside. What I'm going to do is that I'm going to lock these two down, and then what we'll do is that we'll review them on an ongoing basis. I'll end up saving this, and we'll end up having. Let me go back and see if there are any last questions, okay, before we kind of end up wrapping up here. Based on the IV graph, would I buy longer term? Okay, the answer is yes. Okay, this would be one trade. Now realize that we do have a lot of risk in this trade because we really don't have volatility is not hedged well in this graph, meaning that the front month volatility is going to end up spiking. If we have a big drop, it'll end up spiking much faster than the back month. And we saw that especially, a year ago in late August, where the back month ended up moving up, but the front month, okay, went from 10 to like 36. The back month went from like 14 to 18. And so the concept of this is not a one-time monthly battle. It's a multiple-month war, meaning that we're going to take this and we're going to roll this month after month after month. So I call the back months my anchors. Okay, I worked with this institutional client. We had where he wanted his back month anchors to be. He didn't worry about smaller pullbacks. He needed something further back, okay, more than 5% is where he wanted his anchors to be. And then we're going to end up selling every month based on his forecast of where he thinks the market can go up and where the market can go down to. And that's where we're going to end up selling our two puts, knowing that for this front month put here, we have to end up selling it at a long enough term so that when we are not selling stuff that's already crushed, okay? Remember, okay, because this was the important part of this trade. When we end up doing this roll, IVs are so low right now that we didn't want to do it now, but the concept would be not to sell it with a few days left to go, but it would be to sell it with, you know, a month and a half to 3 months, so that what we're going to take advantage of is the portion of the curve that collapses the most. And because we ended up buying this over here, we spent a lot of money for the implied volatility, but we think that over time that these are very low and these should be driven up so that we think that we're going to be able to sell multiple months, not in the 11 range or not even the 13 range. We think we're going to get to sell a whole bunch of months in the 15, 16 range. And because of the theta, okay, decaying so much slower in the leap, we know that even though this implied volatility is higher, that we'll have multiple months. Our risk of the trade is not so much if we pull down, right? Because if we end up, okay, and let me move it to the side a second. If we pull down pretty hard, we know that the implied volatility of the extra vega in the back months is going to end up helping us. We also know that the front month IVs are going to end up jumping up pretty high, and that's why, from what he was doing, the more defensive ones were that we were using backs of 2015, and the fronts we were using 215, and the front months we were using 215 and also like 220, in the 220s, nothing above the money, because that gave us more protection to the downside, and he didn't need it as much to the upside. Okay, so a little bit different trade, but again, this is what we're taking advantage of, is two parts. One, we're trying to buy this cheap. In our case, we bought it cheaper than it is right now. Two is we want to be able to sell these things when they're a little bit higher because we know that they're going to get crushed. We ended up selling January at the time. Why? Because we knew that earnings would be starting to come out, but we're probably going to end up being able to buy back the Januaries relatively cheap and then maybe roll out and sell what we would probably look to sell as the Marches. You see, because you can see selling the Aprils, there's not so much of a collapse. The bigger collapse ends up happening, okay, from March in. That's why selling these things is usually very, very beneficial. Okay, so that's pretty much it. The trade is a calendar leap. Okay, we'll end up doing this. Some people call them campaign calendars. We're going to end up keeping rolling this, and it'll end up being a trade that I end up putting on. What I'll end up doing is that on the home page, I'll try to get this trade on tomorrow when the market opens. On the home page, I will end up putting, I'll have Tom put on the trades, the specific trades, what I put on, and the price that I got filled at. Okay, so you'll see that on the home page. Hope this was helpful for you guys. What we'll end up doing next week is we'll go into the difference of the modes of the Kevlar that you guys asked about specifically, but what we'll end up going into next week is that I'm basically trading the difference between a broken wing and a regular butterfly. Is, for those of you that end up knowing the example that we just ended up doing, let me put in the following, just to give you a quick example. Let me just do a deep and wide butterfly. Okay. Let's just do 5 points to make life a little bit easier here. Okay, so here's a 41-cent butterfly in March. Sorry, I know it's far below the money. But basically what a broken wing would be is that I would end up selling another put vertical on the downside. So for that, basically what I would be selling is that I would be selling, let's say a deep and wide. Let's make it an extra 2 points. And I should have said sell. Sorry about that. Okay, so basically I'm selling this extra 2-point vertical down here. That's the difference. So when I think about a butterfly, a broken wing butterfly, everybody ends up saying, oh, well, this is the way it should be priced, right? And it is the way it is priced. Here's the butterfly, broken wing butterfly for 13 cents. You can see that the upper wing is 5 points, the lower wing is 7. Really the way I do it is that I dissect my positions, right? By butterfly dissecting. And so what I do is I take a look at this. Whether or not I'm going to end up selling a broken wing or putting on a broken wing butterfly has a lot to end up doing with how much credit I'm getting for this. I know the flatter the put skew, the more money I get for this. The steeper the put skew, the less money I get for this. And we'll go into that next week. Okay? Hopefully this was good. We'll end up having the trade. I'll get it on. Hopefully tomorrow. I have a bunch of other trades that I need to get on, but I'll end up getting this thing on. It'll end up going, I'll see if Tom will end up sending out an email to you guys, but I'll at least have it put on the homepage about the leap calendar. Okay, that I'll end up trading. Okay, and I'll keep that thing going throughout the year. Because it's a good trade, even though it's not as good as it had been a little while ago. Anyway, guys, thanks very much. I will talk to you soon, and good luck trading. Happy New Year to everybody.